The moment you lost your freedom didn't happen on a battlefield. There was no revolution, there was no violent coup. It happened quietly in the dead of night, aboard a private rail car bound for a remote island off the coast of Georgia. The cage was built so gradually, so patiently, over so many generations, that by the time the door clicked shut, nobody remembered there had ever been an outside. Every transaction you make, every dollar you earn, every debt that keeps you awake at night, it all flows through a master architecture you never voted for, never approved, and were deliberately trained to never understand. It is a system designed not to serve you, but to extract from you. The architecture of this invisible prison was finalized in 1913. That is where the thread begins. Or rather, that is where the thread stops being a thread and becomes a chain. The Federal Reserve Act was signed into law on December 23rd, while most of Congress had already gone home for Christmas. And the men who might have stopped it, the ones with the wealth, the influence, the iron will to mount a real opposition, were conspicuously absent. They had boarded a ship the year before. It was called the Titanic. But the Titanic is just one piece. One single chilling moment in a pattern so long, so wide, so meticulously constructed, that it stretches back centuries and forward directly into your wallet right now today as you watch this. This is not a story about a ship. This is a story about money, about who creates it, who controls it, and who decided long before you were born that you would never be allowed to ask those questions out loud. Before we can understand what was taken, we need to understand what it was like before it was gone. Before we can grasp the architecture of control, we need to walk through the world it replaced. Because that world has been so thoroughly erased from our history books that most people don't even know to mourn it. Go back to the early 19th century, not just in America, in Britain, in continental Europe, in the emerging economies of the New World. Money was local. Messy? Yes. Imperfect? Certainly, but local. A bank in Ohio issued its own notes. A bank in Virginia issued its own. These notes were backed, in theory and often in practice, by something tangible. Gold, silver, land, agricultural commodities. In some cases, the banker knew his depositors. The depositors knew their banker. Accountability was geographic. It was human. Was it a perfect system? Absolutely not. There were panics. There were collapses. There were fraudulent institutions, wildcat banks they called them. There were panics. There were collapses. There were fraudulent institutions, wildcat banks they called them. In your mind, as we move forward through this history, the failures of the old system were visible. They were localized. When a bank in Tennessee collapsed, it didn't collapse London. When a speculative bubble burst in Philadelphia, it didn't automatically trigger cascading systemic failures in Paris and Hamburg. The system was fragmented, yes, but fragmentation, it turns out, is also a form of insulation. A ship with compartmentalized hulls can take on water in one section without sinking the entire vessel. The deeper I went into the historical literature, not the sanitized high school textbooks, but the primary sources, the legislative records, the private correspondence of the men who actually built the modern financial world, the more I noticed something incredibly strange. The loudest, most persistent, most well-funded critics of local banking were never ordinary citizens. They were never the farmers who had lost savings. They were never the small merchants who occasionally got stuck with worthless wildcat notes. No, the loudest critics, almost without exception, were the largest financial operators of their age. Men who already commanded immense, unprecedented capital. Men with deep, structural connections to European financial houses. Men who had absolutely everything to gain from the elimination of their smaller, local competition. This raises a simple but critical question. If the old system was so chaotic and deeply harmful to the public, why were its most passionate opponents drawn so consistently from the very top of the financial hierarchy? Why not from the bottom? I kept asking that question, and it kept leading me somewhere profoundly uncomfortable. Look at the timeline. 1694, the Bank of England is chartered. 1791, the first Bank of the United States. 1800, the Bank of France. 1816, the Second Bank of the United States. 1876, the Reichsbank consolidates. German monetary functions. 1907, the Panic. 1908, the Commission. 1910, the Meeting. 1913, the Federal Reserve Act. Look at that sequence again. Do not look at it as a timeline of natural organic evolution. Look at it as a campaign, a long, patient, multi-generational campaign to answer a single ultimate question. Who controls the creation of money? Because here is what the textbooks tend to gloss over. A central bank is not merely a bank. It is not merely a lender of last resort, or a stability mechanism, or a technocratic institution for smoothing out rough economic cycles. A central bank is the entity that determines how much money exists. Read that again. How much money exists. If you control the supply of money, the total volume of it in circulation at any given second, you control the price of absolutely everything. Not directly, not with a dictator's decree or a legislative memo, but inexorably, mathematically, through the cold mechanics of supply and demand. More money chasing the same goods means prices rise. Less money means prices fall. Expand credit and businesses boom. Contracted and they fail. Not because they were badly run, not because their products lack value, but because the medium of exchange itself was deliberately made scarce. The official explanation tells us this terrifying power was handed to central banks because it was simply too dangerous to leave dispersed, too volatile, too prone to mismanagement by lesser institutions. But that framing conceals something vital, something I kept noticing as I moved through the historical record. When the power to create money is dispersed, held by hundreds of local banks, by competing governments, by independent institutions, no single actor can use it as a lever. No single decision affects everything simultaneously. The system is imprecise, yes, but it is also deeply resistant. Resistant to top-down manipulation, resistant to coordinated systemic extraction. When that power is concentrated, held by one institution, or a small, tight network of institutions operating in lockstep coordination, the lever becomes entirely functional, and someone's hand is firmly on it. That's where the pattern becomes impossible to ignore. This is where the physical evidence starts to speak. Go and look, really look, at the monetary instruments. This is where the physical evidence starts to speak. Go and look, really look, at the monetary instruments. Distinct forms of legitimate currency, credit instruments, and monetary substitutes circulating simultaneously in the 19th century. I'm not talking about fraudulent paper. I'm talking about legitimate instruments, silver certificates, gold certificates, treasury notes, issued directly by the government, not by a private institution, but by the government itself, backed by actual metal, redeemable on demand. And then systematically, over a period of roughly 50 years, they disappeared. Not all at once, that's important. The erasure did not happen in a single dramatic sweep that might have provoked armed resistance. It happened in layers. First, conditions were created that made competing instruments slightly less convenient. Then regulatory frameworks made them technically legal but practically difficult to use. Then quietly, legislation removed them from circulation entirely. Each step was justified on its own terms. Efficiency, standardization. Legislation removed them from circulation entirely. Each step was justified on its own terms. Efficiency, standardization. But ask yourself, who defines the public interest in monetary policy? And how do we know that? The definition being used is accurate rather than merely convenient for those writing the dictionary. The silver certificate offers perhaps the most striking case study of this silent heist. Here was a monetary instrument issued directly by the U.S. Treasury. It was backed by physical silver held in government vaults. It required no private intermediary. It required no interest payment to any banking institution. The government issued it. The government backed it. Citizens used it. By 1963, it was gone, erased, not because it had failed, not because it was producing financial instability. The official record shows remarkably little public demand for its elimination. What the record does show, if you read carefully, is sustained, quiet pressure from the banking sector over the preceding decades. Pressure framed in the language of modernization, of streamlining, of bringing American monetary practice into alignment with international norms. International norms set, in large measure, by institutions whose own bottom lines were directly served by the silver certificate's disappearance. The deeper I went into these transitions, the more I noticed the same glaring absence again and again. Not just the absence of the monetary instruments themselves, but the absence of debate, The genuine, public, fully informed, fiercely contested debate that a decision this historically consequential should, in any functioning democracy, have produced. The silence in the historical record is deafening. If this sequence of events is new to you, if you've never been taught this version of monetary history in school, you're not alone. Most people haven't, and that in itself might be worth sitting with for a moment. Let me explain as plainly as I can the mechanism that makes central bank control of money creation so incredibly devastating to your personal sovereignty. When a central bank issues currency, when it creates money, it does not in the modern system simply hand that money to governments or citizens as a public resource. It lends it. Money enters the modern economy almost exclusively as debt. It is borrowed into existence, and debt by its very definition carries interest. This is not a conspiracy theory. This is a dry mathematical description of how the macroeconomic system actually functions. You can verify it in any introductory central banking textbook, any Federal Reserve publication. The mechanism is openly, proudly described. What is less openly discussed is its terrifying implication. If all money is created as debt, then the total amount owed, principal plus interest, is always strictly greater than the total amount of money in existence. The interest was never created. It was mathematically promised, but never physically owned or digitally issued, which means at the systemic level, there is always more debt than money, always. By design, what does that mean for you in practice? It means that taken as a whole, the economy cannot pay off its debts without someone going bankrupt. It is a massive planetary game of musical chairs. For every loan that is repaid in full, some other actor in the system must default, because there simply isn't enough money in circulation to retire all outstanding obligations simultaneously. This isn't economic pessimism, it's middle school arithmetic. And here is where the pattern repeats with unsettling, brutal precision throughout the historical record. Every major economic crisis of the modern era, the Panic of 1907, the Great Depression, the stagflation of the 1970s, the catastrophic financial collapse of 2008, follows an identical, recognizable sequence. Credit is expanded. Asset prices rise, debt accumulates in the hands of the working and middle classes. Then, for reasons that are always presented to the public as technical and completely unavoidable, credit is contracted. Money becomes scarce. Debtors cannot service their astronomical obligations. Assets are seized. Wealth transfers rapidly and violently from the many to the few. And after each crisis, the solution proposed on the evening news is always some version of greater centralization, more coordination, more unilateral power handed to the exact institutions already sitting at the center of the system. Not less, never less, always more. I am not explicitly stating that every crisis was engineered in a smoke-filled room. I am asking a much more precise, much more dangerous question. Who benefits from the pattern? And who had the knowledge, the systemic position, and the financial incentive to anticipate it? In November of 1910, a group of men boarded a private rail car at a New Jersey station. They used first names only. They traveled under the cover of night. Their destination was Jekyll Island, a highly exclusive, private resort off the coast of Georgia, accessible only by a boat owned by a club whose membership comprised the absolute wealthiest families in America. They stayed for roughly 10 days. When they left, they carried the draft of a document that would, 3 years later, become the Federal Reserve Act. This is not disputed history. This is firmly in the historical record. The participants themselves eventually wrote about it. Not immediately, of course. Not while the legislation was being hotly debated in Congress. But years later, when the system was already so deeply entrenched that their arrogant confessions could do little to change it. Senator Nelson Aldrich was there, Frank Vanderlip, Henry Davison, Paul Warburg, Benjamin Strong were there. Vanderlip himself described the secrecy, false names, the deliberate, calculated concealment. The public would have violently rejected it. And the three wealthiest opponents boarded the Titanic. The disaster rendered their opposition permanently, conveniently moot by their sudden deaths. And then the BIS, the Bank for International Settlements, The central bank for central banks, shielded from any form of democratic scrutiny, above the law. Inflation. The United States dollar has lost approximately 97% of its purchasing power since 1913. 97%. Notice who benefits. The ultra-wealthy are entirely insulated. They benefit from the very process that impoverishes the working class. What was lost when the system was built? Not just purchasing power, not just gold backing. What was lost was fundamental understanding that money is a tool created by communities to facilitate exchange, something that belongs inherently to the people who use it. That understanding has been systematically erased, replaced by a framework in which money is deemed too complex, too highly technical for ordinary citizens to grasp. We have accepted that the most fundamental power in human society, the power to dictate how life-sustaining resources are allocated, is properly held by unelected men operating in unauditable institutions through processes we were never meant to understand. Once you see the architecture of this cage, you cannot unsee it. The messy, local, sovereign world that preceded it is gone. The men who built the walls of our current reality won, and they did it so quietly, so patiently, that today, as you hand over the invisible fruits of your labor to pay off interest, you don't even realize you're a prisoner. You just call it the economy.